Myself, Ashish Chatramata, Managing Director and Fund Manager for Apex PMS at GM Financials Limited. Today we are going to discuss about market overview for October 2025 and calendar year to date and market going forward. Nifty in the month of October gained 4.5%, clearly reflecting investor sentiment and easing geopolitical uncertainties. The mid-cap index, however, rose 4.1%, but the disappointment came from a small-cap index, which just moved up 3.2% in the month of October, indicating investor preference towards safer large-cap names and upper mid-cap stocks during periods of global uncertainty. Global equity markets, however, showed very strong resilience, with Nasdaq advancing almost 4.7%, driven by AI-related gains. MSCI emerging markets during the month of October moved up almost 4.1%. However, Chinese markets saw 4% correction, clearly indicating profit booking due to a lot of outperformance which Chinese markets have done in the last couple of months. However, on a calendar year-to-date basis, Indian markets have delivered a modest gain of 5.8%, largely supported by October rebound seen in the BSE 500. Meanwhile, if you look at the global peers have significantly outperformed on a year-to-date basis, with MSCI World Index moving up almost 19.6%, MSCI Emerging Markets moving up 30%, and in the same period, China has surged almost 33%, despite seeing a good profit booking in the month of October, clearly underscoring the relative underperformance of Indian equities so far. If we speak about FIIs turned net buyers to the tune of almost $2.1 billion in the month of October after 3 months of intense selling. Despite this, they have withdrawn almost $15 billion in the year 2025, reflecting global liquidity tightening and geopolitical risks. This sustained outflows have pressured Indian equities, though the recent turnaround, if maintained, could provide meaningful relief and support to the investor sentiment. However, if you look at domestic institutional investors, they remained a stabilizing force, recording almost $5.9 billion of inflows in the month of October and approximately $73 billion in year 2025 on a calendar year-to-date basis, significantly offsetting FII outflows. A strong DII participation has supported market liquidity and helped contain volatility, particularly across mid and small cap segments. Recent GST rationalization have reduced tax burden on consumption goods, supporting higher volumes and margin expansions. Lower income tax rate are expected to increase the disposable income, driving demand during the upcoming festive seasons. Now we are going to discuss about major economic events in October 2025 and its impact on India. So if you look at IMF World Economic Outlook update in its October 2025 report, the IMF has projected a global economic slowdown due to rising trade protectionism. However, it raised India's GDP forecast for financial year 26 to 6.6% from 6.4%, making India fastest growing economy globally, outpacing China. So the 50% tariff imposed by the US in late August continued to impact India's export-oriented sectors, particularly gems, jewelry, and textiles. This contributed to a 13-month high trade merchandise deficit in September 2025 and an elevated likelihood of continued foreign portfolio investors outflow. The Federal Reserve released its FOMC meeting minutes in October, which influenced global market sentiment. Ongoing global uncertainties, including the potential for a US government shutdown, contributed to market volatility and a strong demand for safe haven assets like gold, which reached a record high. delivering almost 52% year return on a year-to-date basis, and silver delivering almost 68% return on a calendar year-to-date basis. So if you look at the impact on India from an economic resilience perspective, India's economy has shown very strong resilience, primarily driven by robust economic consumption and government investment in infrastructure, which insulated it from broader global slowdown, which is happening due to extreme uncertainties, which is happening at a global level. Strong DII participation is helping absorbing FPI outflows, providing a crucial floor to the Indian stock market despite global volatility. The US tariff poses a significant challenge for export-oriented industries, leading to a widespread trade deficit and pressure on the Indian rupee, which has seen almost 3.5 to 4% kind of correction in the month of October. However, softening domestic inflation increased expectations for a potential RBI rate cut later in this year, which could further boost credit growth and economic activity. The European FTA deal and other diversification efforts are expected to mitigate long-term dependence on traditional markets facing protectionist policies. Look at the corporate earnings so far. Sensex has delivered a top-line growth of almost 8.3% in this quarter on a Y-on-Y basis, whereas the EBITDA growth has been 12.5% for Sensex. But if you look at the PAT growth in the same period is just 3.5%. This is due to front-loaded numbers of banking sector and IT also showing some weakness. Whereas if you look at BSE 500, it has delivered 7.5% sales growth year-on-year basis. But if you look at in terms of EBITDA growth, it has been almost 15.5%, and the profit growth is almost 13.2%. However, if you look at NSE Midcap, it has delivered a top line of 8.1%, whereas the EBITDA growth is just 9.1%. However, if you look at NSE Midcap, it has delivered 8.1% top line growth. However, the EBITDA growth is 9.1%, whereas there is a positive surprise which has come on the PAT numbers, which has grown by almost 15.5% in the same period. However, the interesting part is BSE 500 X of Nifty 50 stocks. So if you look at BSE 500 X of Nifty, the top line growth is just 6.6%, whereas the EBITDA growth is in the range of 18.3%. So earnings season has begun on a constructive note, showing early signs of cyclical recovery. Momentum is expected to strengthen in second half of financial year 26, supported by policy tailwind and improving rural sentiment. Overall, Nifty 50 PAT for companies that have reported its numbers grew 3.5%. Lenders have experienced NIM compression, though asset quality remained stable, a positive indicator, with credit growth likely to improve in second half of financial year 26. PSU banks have outperformed private peers. We have seen PSU banks delivering almost 13 to 14% kind of credit growth, and from a valuation perspective, most of these PSU banks are trading at a reasonable valuation of 1 time to below 1 time price to value. Downstream oil companies benefits from strong refining margins, stable marketing economics, and softer crude price. Mid-cap IT firms have posted positive surprises despite global uncertainty. Obviously, mid-cap IT companies are showing better performance compared to the large cap IT peers. While FMCG players remained under pressure, consumer and retail tech has delivered a mixed set of numbers. Now we are going to discuss about market outlook for the month of November 2025. So there are several factors indicating potential upside. Rural economy is doing very well, and rural recovery is likely to gain momentum with an above average monsoons, supportive agricultural incomes, and rural consumption. Increase in demand, particularly by reduced GST cuts and lower income tax, is going to increase income in the hands of consumers, thus accelerating discretionary spending. These developments are expected to drive consensus earnings upgrade, supporting potential re-rating across indices. To sum it up, while Indian market appears expensive on the surface, underlying economic and policy factors, including rural revival, consumption recovery, and strong domestic institutional participation, provides a solid foundation for potential market gains in second half of financial year 26, though global news flow would continue to impact market movements in the near term. Based on current numbers and the structural tailwind, we still have very positive view on consumption theme. We are very positive on new age, economy stocks. We are very constructive about the CDMO opportunity within the pharma space, and automobile is going to be a key beneficiary of rising consumption and rural economic pickup. So if you look at, we are positioning ourselves as a fusion investing, where we believe that FTPM is an approach which we try to adopt, which is a combination of fundamentals, technical, market dynamics, and psychology. We have already discussed, since a lot of these themes which are looking promising, it is very well positioned in our portfolios of Apex PMS strategy. To sum it up, Apex PMS is a fusion investing where we do a combination of fundamentals, technicals, market dynamics, and psychology, which we call as FTPM approach. Keeping this approach in mind, we are very constructive about consumption as a space, where we believe that a lot of consumption themes will do really well, particularly which are more aligned towards rural economy. We are very positive on new age economy as a space, and that's where a lot of aggregators, platform companies, merchant, payment solutions. This is the space where we believe a lot of growth is possible going forward. And within pharma, we believe CDMO or CRDMO could be a space which could outpace, the IPM as a IPM segment, and where we believe 16 to 17% kind of growth could be witnessed in next couple of years. So these are the sectors where we have overweight positions in our portfolios of Apex PMS.